All right, we are live with the next book review. Today, we're going to be reviewing Naked Economics. I forget who the author is. Me and JT were texting the other day, and he was saying this is good because we're always doing like complex shit. So we're kind of, this book's different. Like what I got from this book, it made me appreciate the government and just like the overall management of our country and how it works. And a couple other things we'll get into. Not gonna lie, I read this book like back in either 2020 or 2021. So if my notes are a little basic, that's okay. But we're going to break it down so that you understand. JT, what'd you take from the book, man? What's your thoughts?
Yeah, so this book is super basic. It was a good refresher on like a few macroeconomic things. I haven't read it in years. I remember even when I read it, it was very quick.
106, yeah?
Yeah, and I read it very quick. Yeah, it was just very basic. So it'd be a good refresher. If you're new to the economic landscape and you're trying to just, get your feet in the game, get your feet wet, this would be a good book to pick up / podcast to watch. Yeah, good intro.
Sweet. All right. So without further ado, we're going to get into it. This one should be pretty short. I got a page and not even a page and a quarter, pretty much like a page and 4 lines, actually. So,
yeah, guys, and don't forget to subscribe and leave your comments. And this has been a good podcast. So we'll see you guys on the next one. Like, let's go.
And let us know what book you guys want us to do next. We're kind of thinking like, man, should we start doing like business books or should we just stick to finance? Y'all let us know.
Yeah, probably ixnay on the business. Ixnay means no, right?
I have no idea. I've never heard that word in my life.
Really? You know how they say like ixnay on the sauce or something?
No. What sauce are you using, bro?
Well,
is barbecue. Shane Sharp. Barbecue, bro. Say no.
Hey, it's Friday. I ain't got my kids. I started drinking at 6 a.m. this morning. Say no.
All right, y'all. Here we go. Let's get into it. So some of these are super dumb, so I'm not gonna read all of them. I'll just read it off.
Bro, you might be funny as fuck.
But right. If it's too dumb, we'll skip over it, bro. It's like, when you're reading something and you have context and you think the context is gonna stick forever, but then it don't. That joke is funny.
Yeah, I remember seeing one of the points like something is made out of irrationality.
Discrimination is usually irrational. I'm just like, I have no idea.
That's what I read. I was like, man. So yeah, guys, no, this is going to be a good one. Super simple, like I said, easily digestible, and it might be a good reference for your future. So yeah.
Yep. All right, here we go. First point. Programs, organizations, and systems work better when they get the incentives right. It's like rowing downstream. We should probably skip over that, huh?
God damn it. Yeah, man.
As with other aspects of the market economy, the price of a certain skill bears no inherent relation to its social value, only its scarcity. That's basically talking about supply and demand when it comes to the economy. Like if there's only one person in the world that cleans houses, you have to pay millions of dollars to clean houses, to get your house clean, because you have a lot of people bidding on a small amount of goods / services, whatever you want to call it. A lot of people talk about like the first thing they learn when they go into economics class. I forgot where I was watching this, but the guy was saying like he went into his economics class. The first thing that he saw on the board was supply and demand. It's like the first thing that they teach. That's kind of what I got from that. When if you think about monopolies also, it makes sense because they have a product or a service that they can charge an extremely high price for because it's scarce, because no one else can produce it.
Yeah, so I would think about it like this. So the blockchain developers, that whole space. So I remember back in 2017, it was very rare to see a blockchain development job that was under 100 grand per year. And the reason is because it was extremely difficult to find someone who could code on. During that time, it was like Python and Solidity were the 2 most popular languages at that time. And over time, as people became more proficient, so you started to cast a wider net of potential developers. Obviously, the potential salary for those developers started to drop. And they're still dropping now just because now you got universities and a bunch of places teaching individuals how to code on the blockchain. And so now the scarcity effect is really no longer there. They're kind of like normal jobs.
Yeah, that's a good point. Okay, next point. GDP, which stands for gross domestic product, represents the value of all goods and services produced in an economy. Tally up the market price of all goods we manufacture and all the services we provide, and you get GDP.
Yeah, I would just add that GDP, he's referring to nominal GDP, which isn't adjusted for inflation. Real GDP is adjusted for inflation. And so what that means is you take the GDP number and essentially minus the inflation rate, and that's what your real GDP would be. Then you got GDP deflators, all that good stuff.
Yeah, he brought up GDP per capita. He says the nation's GDP divided by its population. Are there certain times where you would like use the GDP per capita, GDP this, GDP that, like for certain things? Like what use do they have to like an investor or like a macro investor?
Probably not per capita. Maybe there's someone who uses GDP per capita. And then in terms of GDP, nominal GDP or real GDP, I guess is more so to help understand more of potential Fed policy, even fiscal policy, because obviously that tells us at the rate at which we're growing, of course, and the rate at which we're going could affect or growing or shrinking would affect monetary policy and or fiscal policy. It would affect your decision to invest in bonds. It would affect your decision to invest in stocks. If, for example, if we have a contracting GDP, either the Fed will respond maybe by cutting rates to spur on economic growth, maybe money printing. So the perfect example was actually COVID, when we had like a negative 1.6% growth. So we contracted 1.6% in one of the quarters. I can't remember exactly. And obviously, that's why one of the big responses to the pandemic was heavily print money, but in a fiscal form. And so we got money directly to households, which is why we're here. So that GDP is more of an indicator.
Okay, so that's a perfect segue into our next point. It says fiscal policy uses government's capacity to tax and spend as a lever for prying the economy from reverse into forward.
So that's the example I actually just gave. During the pandemic, we had huge fiscal injections directly to the American consumer. You notice we don't say the American citizen anymore, by the way. Like we say American consumer. But anyway, so the fiscal policy, or I'm sorry, the fiscal injections went straight to the American consumer, and that helped to spur economic growth. And so because we're consumers, we started consuming heavily, which is part of the reason inflation got so entrenched. So yeah, that's really all I would say, just to keep it very basic.
Okay, the next one, they talk about monetary policy. It says the Fed can raise or lower short-term interest rates. I remember we were talking a while ago and you were saying like monetary policy is Fed, fiscal policy is like government. Did you want to maybe talk about like the difference between these two so that people kind of have like a better idea?
Yeah, so my apologies, guys, if you're watching this and you already know all this shit, my apologies. Like I said in the beginning, it is very, if this is your intro to economics, is actually super perfect. So the difference between monetary policy and fiscal policy. Monetary policy is carried out by the Fed. Fiscal policy is carried out by Congress. They are not the same, but they do commingle, which is once again the example I just gave. With the Fed printing money essentially to push out through Congress. So yeah, that was like a cooperation between monetary policy and fiscal policy. And the difference, I think, was illustrated best, at least in our lifetime, during this recent episode in which we realized that the Fed interest rate hike cycle didn't take as much effect as quickly as they would like. And the reason is because most of the inflation that we've experienced over the last has been fiscally driven versus monetarily driven. And so the Federal Reserve's tool to handle inflation, they don't carry the same effectiveness when it comes to carrying or handling inflation that was driven by Congress. And the reason is when the Federal Reserve prints money in monetary policy, they affect more banks, and so they affect the rate at which banks lend, essentially. If they're so they let me say it this way. So the Federal Reserve could print money and they inject it through the banks. When you inject it through the banks, it affects bank lending. And bank lending is obviously them lending from or them lending to other customers. That could be, someone for a home renovation project. That could be a developer for a project. It could be multiple types of loans that they're lending out. Now, what happened during the pandemic is they skipped the banks. They went straight to the consumer. And so now the consumer is going to spend that on consumer goods. When the Federal Reserve prints money and it goes to the bank, it's generally more productive than fiscal injections. Because like I said before, you're doing home renovations, you're giving it to smaller banks, like you're whoever's borrowing that money from these banks, they're most likely doing something productive with it. That's going to have some positive effect on GDP in the long run. With the American consumer, or not like I was talking about another country's consumer, but anyway, with the American consumer, they're, like I said before, going to buy consumer goods most of the time. So they're going to go out and buy toilet paper, bread, all the shit that we need, the essentials. And so while that has a huge effect on prices, it doesn't necessarily have a positive effect on GDP, because now demand increases and then you run into supply chain problems, which we saw back, coming out of the pandemic as well. And so, yeah, for the sake of keeping it simple, once again, I'll stop there. So that's primarily the difference between monetary and fiscal policy.
What's funny, man? I feel like a lot of that stuff like affected the bank's like profitability and other things, obviously. I was talking to Jeff today. He's my processing guy. We both work, me and JT worked in processing for like 3 years back in like 2016. I was calling him to set up my own account for processing on Know It Alls. And you remember how ACH used to be pennies on the dollar?
Mm-hmm.
Now it's a 1% fee because banks changed the prices because they've been so unprofitable. Isn't that crazy? 1% gross.
It's interesting you say that, because when you look at banks and non-banks / mortgage lenders, like these are the parties that are involved in lending mortgages or lending on mortgages to consumers for consumers to buy homes, right? Now, most of those mortgages that they generated on their books, they're generating about 1 to 4%, like between 1 and 4% on most of the loans that they have out there outstanding. Now, the overnight repo rate right now is over 5%. And so most banks, they use that market. They use that market for short-term liquidity. And it's a very important market. That's why you hear a lot of references to it. It's a $2 trillion market. And so, yeah, the overnight repo rate is around 5%. And so if you're paying out 5% for loaning something overnight and you're only generating 3% on a loan over the course of 30 years, you can make a case that banks are actually, and non-banks and mortgage lenders, they're losing money on a lot of those loans.
Damn. Yeah, that makes sense, bro. Banks are having another thing that I think about, I feel like, the more I learn about economics and finance, I don't even know if I believe this anymore, but like, you think about a bank's customer acquisition costs. Last time I read this, it was somewhere like, it was below $100, I believe, but it was like pretty high. But when you look at a company like Square, PayPal, they don't have to manage brick and mortar, all these ATMs and stuff like that. Their customer acquisition cost is like way lower. So a lot of people think that those companies are going to be the banks of the future. But when you think about the Federal Reserve and how they pretty much got the banks back, it's like, I don't know. But then when you think of a CBDC, it's like, I don't know again. So it's just like.
Yeah, I never thought about the customer acquisition cost for a bank, actually. Yeah, I would assume it's relatively high. And that's part of the reason why they like to take such risk with like high yield investments within the regulatory framework, of course. Or I guess in some cases not, but
Yeah.
Yeah, that makes sense.
My bad, go ahead.
No, I was just finishing off saying that makes sense, actually. I never thought
and
about
it's like
that.
it makes sense that they have all of these little random fees. Like they'll make up a name like convenience customer MIS fee, miscellaneous fee, like all these fees where it's just like, Bro, you just add that on to make money.
Yeah, they probably add a fee on there called the fee. Be like, bro, what the fuck is this?
Right?
All right, man, let's get it.
Interest rate. This is a good way to think about interest rates, I guess. Super basic, but it says interest rates is just a rental rate for capital or the price of money.
The way I like to explain it is like a trickle down. So you can look at it as the rate at which banks lend to each other. That's what I just talked about in the repo rate. That also affects the rate at which banks lend to consumers. And that also affects the consumer in various ways, depending on what they're getting lending for. So yeah, it's basically the rental rate because you're borrowing the money, you're renting the money, and you're paying rent on that money, which is the interest rate. So yeah, that's cool.
Yep. Next point, it says the first rate is the discount rate, which is the interest rate, at which commercial banks can borrow funds directly from the Fed.
That's that's actually, so the discount window and the discount rate is referring to the repo market, actually.
Yeah, and it says when the discount rate falls, banks can borrow more cheaply from the Fed and therefore lend more cheaply to their customers.
So yeah, that's basically what we just kind of described there with the trickle down effect. Like when the discount rate falls or the repo rate falls, which is once again the rate at which banks lend to each other, obviously they can get, you know, a little more willy-nilly with the customers and say, look, now we're only offering 2% versus 4%. So why don't you check us out, you know? And obviously that's how they generate capital. And so the discount rate or the Fed funds rate is very, very important to central banks. I'm sorry, commercial banks.
Okay. All right, next point. The FOMC, which is the Federal Open Markets Committee, sets a target for the federal funds rate, say 4.5%, and then manipulates the money supply to accomplish its objectives.
Yeah, so, you know, they'll set the target. So a lot of the times, actually, believe it or not, the Federal Reserve, they don't know what action they're going to take in terms of raising, keeping the same, or lowering monetary policy, interest rates until the actual like last day, so the second day of the meeting. That's happened sometimes. And so it's not like they just know in advance all the time, like weeks in advance what they're going to do, because they're usually waiting on more data to filter in. And yeah, with the, obviously, once they set the interest rates, what they do with them, when he says they manipulate the money supply, they do that through a perfect example would be them buying the treasury bonds that they bought up over the last decade. By buying up treasury bonds, you're injecting liquidity into the market. By selling those treasury bonds, you're pulling liquidity out. So that's the way you can look at that.
Yeah, and also it's like when they're manipulating the money supply, they always have a desired goal. Like they say they want to keep inflation at 2%, which means if your dollar is worth $1 one year, it's worth 98 cents the next, because they put more dollars into the system with the hopes of it being productive to the economy. But the fact that all these things are so lagging, this is a good way to think about it. And I made this reference in a previous book review or video. It's like steering a big ass ship. If you're in the water and you have like a ship wheel, the wooden wheel, you turn it all the way. It's going to take a while for the ship to turn. So it's like you can think of the Federal Reserve and trying to manage the economy and trying to drive a big ass ship through like a maze. So it's like, let's say you got to do this, and maybe you don't know what's coming on the other side. So you maybe got to anticipate and turn the wheel a little sooner. It's hard because it's not like a jet ski where it's small, where you can just turn in. Like you got to.
That's a good analogy. I think people underestimate how difficult it is to set monetary policy. I would assume it's literally the hardest job in America, for real, and because it affects everything. And yeah, you know, when you look at a ship, yeah, you know, it's a ship, right? You'll say that's a nice ship, but the ship is so big and it's analogous to the country that you say, damn, that's a big ass ship. And that's kind of like the same thing with managing the entire country. It's a big ass ship to manage. So yeah, I like that. I like that.
Yep. All right, next point. We're almost done here. Our faith in paper currency is predicated on the faith that others placed in the same paper.
Yep. Fiat, that's what fiat is. Value by decree. It's a social construct. We talked about this in one of the other episodes. And if people believes our dollar has value, therefore they hold it, it will by default have value. And as we can see, although We talked about the bond issuance the other day. Although we saw a drop in foreign investors interested in holding debt denominated in US dollars, it didn't drop to fucking 20% or zero, you know? So the dollar still has value.
Yeah, and it's like people talk about Bitcoin like, oh, it's only valuable because you have someone trying to buy it to sell it to the next idiot. I think Warren Buffett said some shit like that.
Which is
it's true, don't get me wrong,
but
but
not true at the same time. Just
yeah,
like Bitcoin has its value from being the thing that brought us to where we are today, for real, you know.
Yeah, but it's like if you think about it, that's the basis of all value. Like even my iPhone, it justifies its price because other people think that it's valuable to have a phone.
I would disagree.
No, here, let me elaborate. Even going back to the beginning of time, bro, like fucking
Jesus, this story gonna take fucking
maybe not the beginning of time. Like just going back to like the invention of cars, like it was valuable and people were willing to pay it. Like the free market always determines the value initially until financial products are built around it. You got derivatives and all that shit. But the prices always come from the free market. And the free market is the people saying, I want this because of this. It always starts with the people. If people didn't want anything, nothing would have value.
This is like that argument between subjective theory and objective theory of value. And I would say
objective comes after subjective, I would say.
It's okay. So when you take something like the iPhone, because you brought that up first as an example, the iPhone has value because of the utility it provides, and because of the work that has went to it. That's like the objective side. And so it is literally impossible to sell the iPhone at like, let's say $50, $100, or for free. It's impossible it's impossible to do that. But on the flip side, it's not impossible to do that for like some fruit or something.
Okay, so my point is that you can pay all this money to build an iPhone. Shit, I can start up a startup right now making chairs and spend hella money to go and get the resources, put the leather on the chair, spend money on marketing.
And if no one pays for it, yeah.
So, yeah, exactly. So it's
that's
like
your product sucks.
But my whole point is that Apple's product doesn't suck because people don't think it sucks because they give
because it actually doesn't suck.
No, it doesn't suck. I agree, but it's still coming from the free market because people still are saying, "Hey, I like this phone. I will pay for it."
The price point of $1,000, I would agree, but I don't know how much an iPhone costs to make. Let's say it costs $450 to make an iPhone. I think it probably costs more than that, but let's just say it. Now, the $450, people will still buy the phone because of the utility. They wouldn't even really think on it. You know, they would still buy the phone because of how valuable it is. Now, the subjective side comes in. Look, well, it's just, bro, even people who don't think an iPhone is valuable, when they get it, they're like, damn, it actually is super fucking valuable. Like, it's objectively valuable. Based on how our world operates today, the iPhone is almost a necessity. And so it has like what I was going to say is the $1,000 price point. That's where the subjectiveness comes in because we hyperinflate the value in terms of a number. And so it's like, which is why, I paid $1,100 for my latest phone here. And I don't mind doing that just because subjectively, I get it. Like, yeah, it's valuable. But also to me, I get my whole ecosystem set up on Apple. So it's like, I can never switch my phone. But yeah, so the objective sense is that if the cost was $450, no one will complain because of how, like literally the way our world is set up, the iPhone has inherent value to our lives on a daily basis. It does. And the subjective sense comes in when you get to that $1,000 price point. We say, hey, people love this phone so much that no matter where we priced it, they would still buy it. And now we see everyone still buying the phone. So more people are going to buy it because they see everybody still loving the phone, essentially. It's like, bro, no matter what you charge for it, they can get up to $3,000. That's the subjective side once again. And people probably still buy the iPhone, especially if they're offering financing, which also plays a role in the value of purchasing a $1,200 phone.
Right. So what I'm saying is Like even when you say like with how our world is set up, even if the phone's $100, with how our world's set up, the value is still going to come from people thinking it has value from the objective value it will give them. So that's why I'm saying I still think it always starts with subjective value no matter what.
Yeah, it's like I can see why you say that. Yeah, but it's like certain things don't have value at all. And then even once the subjective value side kicks in, you can still say, like a Bitcoin, it still has no objective inherent value, the system itself. Like that's just an example. So the objective side never has to come. Like that doesn't mean it just pops up. Because
Yeah, like
objectively, the iPhone, look, bro, let me say it like this. I've made just from one iPhone, I made over $200,000. So what's that iPhone worth? I was only working on my phone. And so what's that iPhone worth?
it's probably worth still the same. It's not like you can sell it to someone for 200,000 just because you get some of it.
Exactly. So it's like theoretically or subjectively, anyone could argue like, damn, the value is this, because I could say it's worth 30 grand. I could say it's worth 100 because, bro, you can make millions of dollars from your iPhone. So it's worth this from your iPhone. I probably can't do the same with a fucking Android. You know what I mean? But they both are very similar phones that have, in some sense, objective and subjective value.
But it's like, no, like that point is just like things can have value even when they don't offer shit. Like look at NFTs, you know what I mean? Like you had NFTs trading for millions of dollars and it was literally a picture that didn't get you shit.
That's an example of 100% subjective.
But exactly. But
what's the argument here again, bro?
Subjective, objective theory. Basically,
are we disagreeing on anything?
My point was that all value comes first from subjective, what value people place on it, based on how our world is set up, whatever factors you want to put on it.
Okay. Yeah. No, I guess I didn't really disagree. I'm just talking about both sides, objective versus subjective theory of value.
Yeah. Well,
which both come into play, like I said, on the iPhone. I think we both agree on that either way, because it's all philosophical and abstract, and we could turn into Keynesian versus Austrian. We'll never agree.
Yeah.
On something that could be one and the same.
Hey guys, leave a comment on what you guys think on this. And whoever leaves the best comment, we'll give them a discount on our course, which is yield farming, derivatives, stock investing. Pretty much, we teach you how to handle your multi-asset portfolio like a professional. And we have the best course on like generating passive income in DeFi through something called yield farming, which is loaning your liquidity out to facilitate trades on decentralized exchanges and borrowing on lending platforms. Leave a comment. Whoever has the best one, we'll give them a discount. All right, let's go to the next point. When different countries are better at producing different things, they can both consume more by specializing at what they do best and then trading.
Yeah, that's how globalization comes about. Basically, division of labor on a mass scale, which is why, you know, the reason globalization came about is basically division of labor on a mass scale. For example, if you look at the US, we consume more than we produce. We're a consuming nation. China, on the other hand, they produce more than they consume. That's why they're known as like one of the manufacturing countries in the world. And so, yeah, so it makes sense to trade with them because they can produce certain things more efficiently than we can. And if we were to produce, think about everything you buy. If we were to produce everything that we have available for consumers in the US, it would be expensive as shit.
That makes sense. All right, next point, almost done here. Lowering trade barriers has the same impact on consumers as cutting taxes.
So lowering the barriers for trade, that's what he said, right? Lowering the barriers for trade. Yeah, so that we just kind of discussed that. Imagine if we manufactured everything here in the US, it would be expensive as shit. And so by opening up those lines of trade with China, we get cheaper items or whatever. Let's say even Germany with the BMWs, you know, imagine if we made something equivalent to the BMW in the US. For example, think about how expensive Teslas were when they first came out. It had to take years of unprofitability to experience deflation in their prices because they were able to produce way more, which is why it was a goal for him to build the gigafactories, because that helps lower the price in the long run. And so if we produce everything in the US, it always comes with a higher price point initially. unless deflation really doesn't kick in a meaningful way. And Elon Musk was able to force his deflation by, being able to produce more units.
That's a very interesting point. Next point is trade helps poor countries get richer. That's pretty obvious. If you're a poor country and your land is rich in gold or cobalt or whatever, you can export that to make money.
Most countries, though, they're pretty corrupt. So only a few people actually get rich and the country actually stays pretty poor.
Yeah, unfortunately.
Yeah.
All right, 2 more points. Excessive regulation goes hand in hand with corruption. Government bureaucrats throw up hurdles so that they can exert bribes from those who seek to get over or around them.
Damn, he just changed the tone real quick, man. Yeah, I mean, you could say that's what's happening with crypto. You can say that's what's happening with green technology from big oil companies. And so they lobby for these politicians / bureaucrats to basically protect them.
Yeah, I remember reading in the Master Switch, like reading about the uprising of like AT&T and Western Union and how like they would get super big and they would go to politicians to get certain things passed so they can like keep their monopoly intact. Politicians get reelected. Definitely recommend reading that book.
Yeah, it costs hundreds of millions of dollars. I think Donald Trump actually spent over $1 billion during his election, to give you an example how expensive that shit is. And so politicians need lots of funding.
Lot. Next point. All countries that have had persistent growth in income have also had large increases in the education and training of their labor forces. I guess it kind of seems like growing a tree. Like when you constantly water and feeding into something, it shows up on the balance sheet.
I think that's a psychological thing too. Like when you make more money, you just want to be better. Like you want to do better things. You want to know more. And I think that a big problem with inner cities, for example, like people don't realize how big of a problem is. Like sometimes people aren't able to take their kids to school because they don't have gas money. You know what I'm saying? And if that happens for one person enough, they'll probably eventually, if they don't find another way to get their kids to school, that kid is going to lack education. It's probably going to drop out, whatever it may be, if they don't find another way. That's just one small reason. And imagine that and a myriad of other reasons compounded with a bunch of people. And it's like, that's why you see lower education rates in impoverished areas, because wages generally don't go up. They actually stay stagnant in impoverished areas for the most part.
Man, that's interesting. It almost seems contradicting because it's like, I don't know if that's a binary thing. Like you get money, you want to do better. Like some people get lazy. It's like that quote.
I think it's the amount. I think the amount matters though. Like if you make good money, like if somebody's making, let's say, 20 grand a month, but they have to work for that 20 grand a month, that will make you want to get better. But if you just make $5 million and you didn't really have any ambition before, yeah, you're gonna be lazy as fuck. But like most people, if they found a way to make 20 grand and they have to work to do it, they'll do it. And a lot of the times, in order to do something consistently, you have to fix habits in other areas of your life. So like it's like the byproduct of trying to make a lot of money is becoming a better person, not morally, just better performance wise.
Yeah, I guess that's a good point. It's still hard for me to agree 100% though, because it's just like,
he agrees with me, guys.
If a person's making 20 grand and he's working hard for it, he's making
not working hard, just work. That's what I said, just work for it. Like if he has to put in some work, it doesn't necessarily have to be going to the factory, like that type of hard work, because that's the worst type of work to me.
But think about it from like a nation standpoint. Like it's like that quote, a nation is born stoic and dies Epicurean. And that like people say, strong men create good times create weak men create hard times, that whole cycle thing. So I think like from a nation standpoint, like reading Ray Dalio's book Changing World Order, which we're going to review here pretty soon, it's going to be a good one. Like all nations go through this prosperous phase and they get lazy and then they decline.
So it's not so black and white like that though, man.
Exactly. That's what I'm saying. It's not black and white. That was my whole point that I was trying to prove with that. Like
yeah, but I'm not making a black and white point though. I'm just saying, like, if someone look, there's people like the people who are going to find the ability to make 20 grand. They're not a lazy person. They're always going to be lazy people, which is that person who probably made a lazy person can make $5 million in something, in one transaction type deal, like, or two or three. A lazy person could do that if they're inherently lazy. Someone who makes 20 grand consistently, they're probably not so lazy. And I know that's it sounds weird because that person made more money, but it happens all the fucking time, guys.
This conversation has a lot of modalities, bro. Like I remember,
Bill Gates. Just to finish the point, real quick, because I'm gonna lose it. So the person who made 5 million, you could look at that as like some rappers who will make a few $1 million, and then you never see or hear them do nothing again, and then they're 40 years old eventually and they're broke. It's because they're actually lazy. They didn't know what to do. They didn't take the time to think, like, maybe I should learn a fucking new skill. But that person who made 20 grand in 1 month, he still has bills. That 20 grand is going to be gone very quick. So instantly, first off, the fact that he made 20 grand, he impressed himself, and he realizes he can do it again. It's harder to make $5 million again than it is to make 20 grand. And so that person is probably going to be more motivated most of the time to change some aspect of their life to continue doing that, especially if they realize it's something that they did that made them 20 grand. Not like some special talent that eventually goes away and you become irrelevant, like a rap career or something like that. They can do this as long as they have their mind right, until they're 60 or whatever. And so they're going to be more inclined to do something to better their habits in some other area of their life so they can continue bringing in 20 grand a month. That's what I would say. That's what I was saying.
Yeah, this conversation, it definitely depends on the person for sure, is what I would say. It's definitely not a black and white thing.
I think most American, I don't know if did I say black and white?
No, I'm just saying.
I think most Americans, though, once they make 20 grand in a month, not even most Americans, but a good chunk of people, they'll figure out a way. Other people, they probably not even gonna know how they made 20 grand, so they'll never do it again. But there's a good chunk of people who will have motivation to better themselves. So that way, because once you make 20, from experience, now you start thinking about how you make 60, how you make 80, how you make 100, because you realize what's possible.
Some people think about what they can spend on it. That's what I'm saying.
No, that's facts. It's always going to be, I don't know, man. America's just not black and white at all. And it's just so many different moving parts, and it's just
we can end it.
You can get 20 people together and they could all do something different. They could all be very different, like in terms of what they'll do in that situation. Like it's probably something we haven't even thought of.
Yeah. Last point, guys. If the World Bank is the world's welfare agency, then its sister organization, the International Monetary Fund, or IMF, is the fire department responsible for dousing international financial crises. So I don't know what the World Bank does, but I do know that IMF, like what's El Salvador? The IMF is like it says the fire department responsible for dousing international fire crises. So basically, the IMF puts people in golden handcuffs. They'll loan people money, and in exchange, the country, like they have to do certain things. So like, for example, El Salvador was getting money from the IMF, and then they started, acquiring Bitcoin, made it legal tender, start mining Bitcoin with their volcanoes. And then the IMF was like, hey, motherfucker, we're going to cut your money off if you keep doing that. You know what I'm saying? So it's almost like they created their own piping so that they can have their own fire hydrants, so they don't need the IMF anymore.
That's so funny they start mining Bitcoin. Like
it's working.
That's like you getting a loan to renovate your house and then going to buy a car to rent out on Turo. That's funny as ever, man. But yeah, no, I don't have anything to add to that, by the way.
Yeah, we will end it there, guys. If I had to give this book a rating, I would give it a 7.9, just because of the timing that I read it in. It did add a new block to my block building of financial understanding, I guess. I did learn a lot from it, even though it wasn't like hella notes in here, hella basic notes. A lot of this stuff is, you can boil it down to like in a simplistic way. And I feel like that's what this book helped do for me. So I would definitely recommend it. What about you? What would you give it if you can remember?
I'll give it probably a 8, just because it's really good for beginners. It really is. Like, you know, if you guys are just not familiar with economics, that's kind of why it's called naked economics, because it's kind of taking off all the extra swath. So yeah, it's a good intro for you. So I would give it an 8. Would I read it again? No.
Same.
But yeah, like if I'm just getting into economics and I saw this pod, I would have definitely bought Naked Economics. Because even though I say it's for beginners, it's not for the person who this is their first time learning about economics, like literally like the day you started type deal. Like, all right, I'm going to sit down and try to learn this stuff. You know, it probably won't be the best, but you know, give yourself literally probably a few weeks of like diving into things every single day, and then you read this book. Whatever you learned over the last few weeks, it'll kind of tie it all together. So
For sure. And even if you get one nugget out of it, it can help you when you read something else that's complex. Like it can be that little screw that you screw in to help that machine function in your brain, if that makes sense. So yeah,
no, your brain is a machine for sure, and my machine has been overworked. So I'm gonna let you carry us out, and I appreciate you guys. Leave a comment, leave a like, and yeah, let us know. You know what else? I think Vince, you said this in the beginning. If there's like a specific book or topic you want us to kind of break down, feel free to throw that in the comments. And yeah, guys, I'll let you carry us out, bro.
Yep. If you guys want to book a free consultation, go to Know It Outside XYZ. We're only accepting certain people. I already said in the middle of the video, like what the course covers: yield farming, trading, derivatives, DeFi security, so you don't get hacked. Pretty much everything you need to secure your financial future. We're in the midst of the largest transfer of wealth in human history. Millennials are set to inherit $64 trillion over the next 8 to 10 years from their parents and grandparents. A lot of that money is going to find its way into crypto and digital assets. Our lives are becoming increasingly digital. It's only right that our money and assets follow suit. So jump on the bandwagon. Like JT said, like, comment, subscribe. Hopefully you got value from this. Let us know what book you want us to review next. And with that, see you on the next one.
Peace.